What subtle manipulations can forensic accounting find in financial statements? Imagine trying to spot a tiny change in a complex puzzle where every piece looks correct at first glance. Financial statements are often meticulously prepared, but beneath their polished surface, some figures may be subtly altered to create a misleading picture. Forensic accountants are skilled at uncovering these hidden manipulations that can distort a company's true financial health. One common technique involves the timing of revenue recognition. Companies might record sales before they are actually earned or before goods are delivered to inflate income figures. For example, recognizing revenue at the end of a reporting period for sales that will not be realized until a future date can artificially boost earnings. Conversely, delaying expenses or costs to a later period can also make financial results appear more favorable than they truly are. Another subtle manipulation involves the classification of expenses and income. By shifting certain costs into non-operating expenses or capitalizing expenses that should be expensed immediately, companies can inflate profits. For instance, capitalizing routine maintenance costs as capital expenditures increases assets and reduces expenses in the current period, giving a false impression of profitability. Adjustments to reserves and allowances are also frequently examined. Companies may overstate allowances for doubtful accounts to reduce current income or understate them to inflate profits. Similarly, manipulating inventory valuation methods, such as switching between first in first out and last in first out, can influence gross margins and net income figures subtly. Forensic accountants also scrutinize off-balance sheet arrangements and related party transactions. These can be used to hide liabilities or inflate assets, creating a distorted view of financial stability. For example, a company might lease assets through arrangements that are not recorded as liabilities, making its debt levels appear lower than they actually are. Furthermore, subtle manipulations can involve earnings management through estimates. Companies often relying on subjective judgments for depreciation, amortization, or warranty provisions. Slight adjustments to these estimates can significantly impact reported earnings, especially when done consistently over multiple periods. In essence, forensic accounting involves a detailed examination of financial statement components, looking for inconsistencies, unusual patterns, or deviations from industry norms. By understanding these subtle manipulations, forensic accountants help ensure transparency and accuracy in financial reporting, safeguarding stakeholders from misleading information.